The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome to the Diagnostic Trading Hour here. I'm your host, Darrell Martin. Call in with any questions you have, 1-877-927-6648. Again, that's 1-877-927-6648. And go ahead and do a quick market wrap for you on where everything's sitting right now. We got the S&P pretty quiet today, basically up a couple points off those lows there. We got the NASDAQ is up 2.5. We got the Russell up 3.5. And we got the Dow up 17. And looking over at natural gas, it's at 0.01 after a pretty volatile ride there. So we'll see how that ends up before the day is over. And looking over at crude, it's down $1.21 on crude oil. So definitely some good rides right there. Had a good signal on that this morning. And looking over at silver, down 0.083. And we got the gold contract down $7 on the day. So a nice move right there on gold. Copper is also down 0.5%, down 0.0185. And looking over at our ags, then we can see right now that we got the soybeans are sitting right now at a down, let's see, depending upon which contract you're looking at, but looking at the December, basically down 19 ticks right there. And looking over at our corn contract, then for the September contract, up 17 points on the day for corn. And then wrapping up the market wrap with Forex, we got a pound dollar, which is up just 17 pips over yesterday's close. Euro dollar down 34 pips. Aussie dollar down 16. So dollar showing some strength compared to those two markets. And moving over on the Canadian, it's up a whole pip on the day. And then looking at some of the other currencies, we got the U.S. franc up 26, Euro yen up 10, pound yen, and U.S. yen. Pound yen's up 0.45, and U.S. yen is up 21 pips on the day. So that wraps up our market wrap. Now let's check out what's going on here with the fundamentals. So on the fundamentals here, we like to cover diagnostic trading. We like to look at fundamentals. We like to look at statistics. We like to look at technicals. We like to look at seasonals. And so we have our fundamentals and basically what happened today. Well, we had the preliminary GDP that came out this morning, and that came out actually at 7:30 Central, 8:30 Eastern time there, and it came in right at expectations. And so if we want to take a quick look at just the S&P, how did it respond to basically being right on target? They were pretty happy. So, but it didn't make as big of an impact as usually we see, but it did have a pretty good impact right there. We can see it did shoot up, about 3 points. And but news basically usually has an impact of about 10 minutes as far as just an immediate impact on the trade. Then it's going to be they're going to start looking at other things and what's going on. So that 10-minute move happened. And then it gave it all back up over the next hour. And then right at the end of that hour, we had another report come out. We had, actually a little bit later than that hour, but at hour and a half later, so 30 minutes after the market opened at 9 o'clock, then we had the pending home sales. We had consumer sentiment a little bit later. But pending home sales came out at 9 a.m., and that came in much better than expected. And that's considered a leading indicator. It's a very positive sign for the market when pending home sales come in positive, because basically that means that's what you should expect in the coming weeks for new home sales. All right, so that's a great thing to do, and it's released a week later than existing home sales, but since it's looking forward, then it's considered a leading indicator. Market got that news, it was very happy with it. Again, shot up a few points right there. So down here, if we look right before the announcement, we had a close of around 1407 and then shot up to about 1410. So about another 3-point move on that. And that was, again, down at, really, that would took about 15 minutes to reach its peak before it gave it all back up. And then it gave it all back up again, not too much after that. And then decided to turn on around 10 o'clock. And we had the crude oil inventories came in much higher. Okay, so meaning supply, the oil inventory that's basically being held was much higher than expected. They expected oil inventories to be down from the previous week by 1.1 million barrels. It's actually up by 3.8 million barrels. And so with that supply increasing, then that led to the massive drop in oil that you can check out here, where you can see that, when that report came out, it sort of spiked up, and then it's already moving down pretty fast. And the 930 report basically sort of locked that in, and it's just been moving down ever since. And now, it's trying to do a little bit of retracement now, and we got a little bit of a trend line it's hitting at this point. So we'll see where that ends up. But definitely, obviously the inventory is having a big impact on oil, and you always want to be checking that one out on Wednesdays at 9:30 Central, 10:30 Eastern time. And we also have the Beige Book, which coming out here pretty soon. And the Beige Book comes out at 1 o'clock. It's not as big of an impact on the market as everything else, unless there's something really weird. But basically, it's just the analysis used by the FOMC to help make their next decision on interest rates. But the reason it's a mild impact, as it receives basically non-public books. So like the Green Book and the Blue Book, which are widely believed to be influential, it doesn't have all that information built into it. So, but of course, it may have a little bit more of an impact today, simply because what's going on. We got Friday, we got Bernanke's speech, and Jackson Hole's going on, and so that's obviously very related to it. And so it's more of anecdotal evidence, and usually, like I said, a mild impact, but the impact could be increased simply because of all the anticipation built up about the possible QE3. So I don't think we'll be seeing the QE3 on this round. I think we could easily see it in one of the next two rounds before the year wraps up. But just depending upon how Europe handles its business, and how our employment reports come in and everything else. As long as inflation stays, inflation without energy and food, but as long as inflation stays low, then that can help them justify that. But we are going to have to see worse employment, so hopefully they won't need QE3, right? Let's get the government out of the way and let the economy do its own thing. And so that sort of is going to wrap it up. We're going to have a lot of moves in the Aussie later tonight around 8:30. They got their building approvals. They got their business confidence report. They have their private capitalization. So, Aussie, New Zealand right there around 8:30 Central, 9:30 Eastern. So if you're trading the currencies tonight, those would be the reports to be checking out and see how those go. And do a little wrap-up for what's coming up again for the rest of the week. Looking over tomorrow, we're going to have, of course, our unemployment claims in the morning. We're also going to have an Italian 10-year bond tomorrow, or overnight. And so that's, of course, could easily have an impact if yields are good versus if they're, if they go up again. So if we start seeing, yields going to 6, 7, higher than 7%, that's going to cause some deterioration in the market. If they're low, then that could cause a little bit of a rally, or at least not have much of an impact. And but beyond the Italian 10-year bond, shouldn't see a big impact. That's, of course, everybody has their eyes on Italy and Spain and Greece and all that going on right now. And we got the unemployment claims. It's going to be coming out in the morning at 7:30. It'll be released the same time as two other reports. It'll be released at the same time as the core PCE price index and the personal spending. So just to recap for you, unemployment claims is basically the earliest economic data we have, and it fluctuates every single week. And traders use it to basically diagnose developments, and they're looking for extremes. So last week it came in worse than expected for the first time in the last 5 or so weeks. So really, basically we haven't had that many reports on unemployment claims that come in worse than expected. And so, obviously not a good thing. But if that happens, that, of course, will have a big impact on the markets in the morning if it's worse. And then we go on down now. Also, make sure, this is real important, when you're looking at these, try to look at the reports and don't just look at just the number, okay? Also look at the details of if they made adjustments to previous numbers. And, it's really important that you understand that. You can find, the press release will go out at DOL.gov. That's where they're going to have that release go out. But you want to look for revisions on them as well. And then looking over, like I said, there'll be two other reports coming out at the same time. Really, actually, I guess there's 3 reports coming out at the same time. And so if those are widely different, these are not big economic releases. They don't have usually any kind of big impact. But they can stunt or accelerate the impact of the move whenever they happen. One of them is the personal spending. That's a pretty important indicator that comes out because, but it usually doesn't have a huge impact. But it's very important information. And basically it covers how much consumers have been spending, over the last several weeks there. And so, and it's going to come out actually monthly. And basically right near where the month ends, so 30 days after. So tomorrow is going to be right on track at the 30-day mark. And it's basically just how much, like I said, how much people are spending. So that's sort of an economic health indicator of are people spending or are they just saving. And then the other one is going to be personal income. So That's going to come in, and that's basically what's the total value of income received by consumers. And so that's, very correlated to, spending, and, it's going to that has an impact when combined together. And so you want to keep all those in mind. Those three will be coming out at the same time. But the big one to watch, the most important one to watch out of all of them, is going to be the unemployment claims. And beyond that, there's not really any big numbers going on tomorrow night that should have any massive impact. And then wrapping up on Friday, we got the GDP in Canada coming out at 7:30 in the morning. And that's going to be, a pretty big thing right there. Also, there'll be unemployment rate in Europe, in Europe and in Italy will be coming out overnight. I know Italy comes out at 3 a.m. and the unemployment rate, just basically the European Union unemployment rate, will come out at 4 a.m. Central and 5 a.m. Eastern Time. Like I said, GDP for Canada will come out, and obviously being a partner with us does have an impact, but they're usually pretty close to target. They actually missed it by 0.1% last month, and then they're basically calculating they'll be at 0.1%. So that's actually showing a further contraction in their GDP. If they do hit that target, if they miss it, then that could be obviously a bad thing, because obviously a big trading partner with the United States. We're also going to have 845 Chicago PMI, and we'll have revised University of Michigan consumer sentiment, how people are feeling about the market. And that's basically what the consumer sentiment is. And the PMI, if you don't know what that is, then that's data that's given. And what it does, it helps you understand economic health, because it's what it's doing is it's looking at market conditions. And it comes from, they basically survey 200 purchasing managers, and they do it in Chicago, and they basically ask them different questions related to things like employment, production, new orders they're looking at placing, how they're looking at setting their prices, what their deliveries, inventories, basically how's their business operating. And so that's what the Chicago PMI, right? And so that'll come out at 8:45, a little bit of an impact. We have the consumer sentiment and the inflation expectations, and that's also a survey of 500 customers where they're looking at do people think the market's going to continue to inflate. And then we got factory orders coming out at 9 o'clock. Very mild, anticipated impact. But the big thing that we do expect to have an impact is Bernanke is going to be talking. And so with Bernanke talking, we always should expect that to have an impact on the market. And he'll come out and he's going to give a pretty interesting little speech called the Monetary Policy Since the Crisis. And everybody's going to be looking for every keyword they can on QE3 and whether or not he's going to be doing it. And not really a big shock and awe, but everybody is so focused right now on QE, and that's been the main driving factor in the run-up recently, that we should expect a very large, a big move. Back in 2010, I think he actually used that to launch his QE2 package. So he used that, and then 2 months later he put that out there. Hold on right there, folks, and come on back, and we'll talk about some more stuff going into the statistics and the technicals.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers, where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kay Stalter, David White, Larry Pesavento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, folks, welcome back here to the Diagnostic Trading Hour. And looking into several things going on in the markets. And one of those things is looking at natural gas, of course, it's been moving quite a bit. Oil had a nice big move. And I just want to go ahead and wrap that up for you, see what we can find out. One of the things I was looking at today, as I was talking to a trader about this, is every once in a while a market moves to a point where you don't really see a trade that's going to, basically give you the risk reward that you're wanting on Nadex. And I don't know if you've checked out Nadex yet, but if you haven't, hop over to TFNN.com, click on the Nadex banner right there, and click on Create an Account. You can get a free demo account right here. Open a demo account. Literally takes about 15 seconds to get an account, all right? And all you got to do is put in your username, first name, last name, phone number, and email address, and apply for demo. They'll send you a password, and a few seconds later you'll have it. And the nice thing about Trade on Nadex is it lets you limit your risk and not get stopped out on a trade, because it's basically what I call a box spread. They call them bull spreads. I call them bull bear box spreads, because if you sell it, it's bearish. If you buy it, it's bullish, okay? And so definitely check that out. It's a great way to trade commodities. If you've never traded them, but you've been wanting to get into them, but you're afraid of the risk and all that stuff, but you want all those great advantages of leverage and margin, but you don't want the risk side of leverage in the sense of, having that uncapped risk against you like you would in normal leverage when buying natural gas, then this is a great way for you to hop over and check them out and trade them. And then you can also open a live account. It's only $100 to fund an account. And, of course, probably want to put more in there than that, but you can do trades for easily less than $100. So hop in there, you fill it out, it takes maybe a few minutes, and you'll be able to get going. And So with that in mind, let's go ahead and I'm going to pull it up and we're going to see what all we can find over here, okay? So we got Nadex right here, and let's go ahead and we'll pull up. I had some corn contracts. Let's show you an example on that here in a little bit. But let's go in and we're going to pull up natural gas. And the way you find them is, by the way, if you're ever having trouble doing anything, just click refresh. It'll shrink everything right down for you, okay? Go to commodities, go to bull spreads. Then you go over and scroll into natural gas. And now you're going to see that there's several time frames. Click on that time frame, and what it'll do is it'll put the spreads for that time frame right there in the Markets tab for you. And you want to make sure you're looking at the same contract as the spread right there. So if we got October there, then whatever platform you're using, whether it be say Thinkorswim or NinjaTrader or whatever, just make sure you're looking at the same one. And I'll pull it up, and we'll look at natural gas. So on natural gas right here. You can see it's defaulting to September. So again, we want to make sure we line up our contract, okay? And there we go. So now with V2, so V being the symbol for October, now we're going to have the October contract. And basically, the reason you're doing that is you want to make sure you're lining up with the same underlying market that the Nadex spread or binary, if you're trading that. Right now we're talking about spreads, but the same binary that you're trading. And a lot of times people are trying to figure out what month to choose and how does that work. And it's actually it's pretty easy to do, and I can show you a couple different ways to do that. But one of the easiest ways is just to hop over to the CME's website, and you can look at this. If you're just trading futures outright and you're trying to figure out what you want to do, you go to cmegroup.com and you go to products and trading. Then you go down to CME Globex. Now scroll over and go to energies, right? Because natural gas obviously being energy. And then scroll down, find the contract. So there's your NG, your natural gas contract, okay? And you can look at, right there, so the Henry Hub there. And it'll take it a minute, but then what it'll do is it'll pop up, you'll fill in all the data, and see where the volume is, all right? So the volume is in the October contract. So even though your platform may default to September, you really want to be using that higher volume contract, more liquidity, tighter spreads, things like that if you're looking just at the futures. And so Nadex is following the October contract. And even though, like right here, when I go in, and I'm not quite sure why they haven't updated the official rollover date, I guess, but they still have it on September, and you should be looking at the October contract on natural gas if you're trading it. So once you know what contract you're looking at, and again, now Nadex won't necessarily always be following the most liquid one, okay, because it'll be following usually the front month one. And but all you got to do is look right there. It'll say in the contract itself, you have to see October, okay, and so in that October contract, then what you're going to be going over is now you want to pull up different spreads and figure out which ones you want to look at. And let me zoom back to normal, and we can look at that. And you want to find ones that are going to be close. So let's say if you had an assumption that you thought that the market was going to be heading down, all right, you think it's going to be bouncing off these highs over here, then you could look at it, and you'll see that we got it at 2.68. And so you want to find something as close to that as possible. So right here we got 2.64. And what that means is I could go in and I'd risk 26 bucks, or if I did 10 of them to equal a natural gas contract, be risking 260 on that trade to make a potential 1740. So when we come back from the break here, I'll show you what that means on the chart and exactly how the spread works and why it has a lot of advantages over simply doing an outright natural gas contract. Stay right there, folks.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Tom O'Brien's daily trading newsletter, Market Insights, has delivered powerful results for subscribers, and now is the perfect time to try it out for 2 weeks absolutely free. We're so confident in the value Tom provides his subscribers in his daily newsletter that through Labor Day weekend only, when you sign up for a 2-week free trial to Market Insights, we'll send you a free copy of Tom's best-selling book, The Art of Timing the Trade, your ultimate trading mastery system, completely free of charge. Will even cover the shipping cost. Cancel at any time during your 2-week free trial to Market Insights and pay nothing, and keep Tom's free book as a gift from us. This offer is only valid for new subscribers. We've only extended this offer once before, and it will only be active for a short period of 2 weeks. So act now to take advantage of this great offer and be ready to capitalize on a more active, more volatile market once traders return from their August vacations. All the details are on the front page of TFNN.com. Sign up for your free trial to get your free copy of Tom's best-selling book today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, welcome back here to the Diagnostic Trading Hour here with Darrell Martin. And what we're doing is we were checking out natural gas when we last left. And it's moving up pretty good, and we got a deviation level. If you're looking at this is very important, looking at the October contract, then looking over at that, what we can see is it's getting very close to that deviation level on the October one. Not quite there, of course, on the front month September, but if we're looking at this for Nadex, then what we're going to be looking at, let's see, is a deviation level on natural gas. Again, this is implied deviation, not standard deviation, 2.72. So it's come pretty close, and it really seems to have backed off quite a bit. Let's just say you were looking to go short. You think at this point we got a move down ready to happen. Then you could go in on the contract and you could sell this. I'm doing this more to explain to you how it works, not so much as a ready, because I'd really like it to get a little bit higher if possible before I went short on it. But right here, looking at this contract, then I can sell this 2,500, 2,700 box spread. And what that means is, I'll draw it on the chart for you. Let's see here. Now we got to rezoom it back to normal. And I'll draw the exact rectangle on there to show you, why I call them box spreads, how it works. And it helps it make a whole lot more sense when you see it visually than when you're just hearing it. And so right here we go over and the box spread. And if you have a drawing tool, I highly recommend you draw it on there. But we got 2,700, and we're going to take this box down to 2,500. Okay? And what I'll do is I'll change up these right here, make it a little bit stronger there. And now what we got to do is go, okay, so if I have a 2,500 to 2,700 box spread, and I want to go oil this, I mean, short natural gas, this would be sort of a dangerous trade for me to do, because natural gas could easily just spike up right now. And, you know, so where's my stop loss going to be? You know, a few ticks away, I could just get hit before it goes down even, right? And that's the worst thing in the market, I think, for a trader, is a whipsaw. And that's when the market spikes against you, knocks you out of a trade, and then goes right back in your direction after you're knocked out. It's one of the most painful things as a trader. And so you're always looking for ways to reduce that from being a possibility from happening. And so this is one of those ways to make that happen. Well, in here, we go into the trade, and let's say we sell over here at 26.79 right now. Then what would happen on this trade is, if the market went up, we wouldn't lose more than $200. Also, you know, we're not putting up that much in margin. So our margin is our risk. So we're going to put up $200 in risk. So it's a great use of our money. And, you know, there's a little bit of premium built in there, but it's basically straddling. So it's doing a really good job as far as the price goes. It's right around the market. The market's right in the mark, right in the middle of the bid and the ask there on the spread. And so we're not really giving up much on time value, but we are getting is a huge value on the ability to allow this thing to not spike against us. All right, so this is just one of, you know, many possible examples of how you can trade the spreads. But now let's say the market spikes up to, let's just say 27.10, okay? If you're in a trade, you're probably out. You probably got stopped out of the trade. And then all of a sudden it starts moving back down. Well, with this trade, when you go short the spread, the box spread, it can go above your box and you can't lose more than the 210, okay? And that's if I'm doing two contracts. Only $21 for one. So you can actually do really small sizes. That's another big benefit if you're getting, you know, you're new and you're getting into it. And then it starts falling back down, and it falls down there before the expiration time, then you actually can profit on the trade. All right? And so the profit, you know, how do you figure out? Well, it's up to 1,700, but that'd take a move all the way back down to 25. Probably not going to happen today. But, you know, the way you figure out the profit is, you know, looking at this right here, every tick, by the way, this is on all Nadex spreads. The tick is always the last digit. Okay? So like a tick on a stock is a penny. All right? So in this case, on the Nadex spreads, a tick is the last digit, and a tick is equal what? So on a stock, a tick is worth 1 cent, okay, or 1 cent being a penny, you know, 100th of a dollar. Well, right here, the last digit, 8, 9, 10, 11, 12, all right, every tick on every Nadex spread is worth $1 per tick, per spread. So if you do 10 spreads, that makes the tick worth $10, all right? So pretty simple. And like I said, you can do 10, you can do 5, you can do 1, you can do whatever, you know, you can do 50, whatever, you know, quantity you want to do. And it's always going to be $1. So if I go in and I decide to go ahead and place this trade, then, you know, how much money would I make? Let's just say if it came back down to, you know, 26, we'll just say 30. Okay, so like right about here, 26.30. If it dropped down to that price level, what would I make on the trade? So if you're at home, you're learning about this right now, you know, see if you can come up with the answer on it. And so right now, if I go in on the trade, and we'll update it to current market price there, and now we're only risking 160 on the trade. And so I'm going to go ahead. I'm actually going to place this trade right now. So now it's back at 200. Like I said, I wanted to see a spike up before we got in. And it's moving on us. Yeah, see it's going. So we're going to go ahead and place it now that we got that spike up. I was waiting for a spike. We got it. And so now we're filled on the trade. And there we go. We can actually see it on the screen. And so now we're going to calculate what would our profit be if it came down to 26. We're just going to say 26.30, just as an exercise for learning how to calculate, you know, potential profit on here. Now we know the potential profit is, you know, much larger than what we're putting on the screen, but the goal is to go, you know, I want to know what I'd make if I got there. So if I got in and I sold at, you know, 1.2677, all right, and let's just say I bought it back at 1.2630. Okay, so 26.30 right here. Then I would have a profit of 47 ticks. All right, and so let me go ahead and do that one more time. So again, that's 1.26. Sorry, 2.677. I'm like, something's wrong here. There we go. It come out the same, but 2.677 minus 2.630. All right, still got 47 ticks, but I just added an extra decimal in there. So 47 ticks. Every tick is worth what? It is worth $1. Okay, so if I want to, there's different ways to do this. Looking at 47, you know that's $47. But another way I could do it is I could go divided by how many ever decimals there are. So there's 3 decimals, so 0.001. And I want to do it on the decimals of how it's quoted. So there's 3 decimal places there. So 0.001. It's putting me at 47 ticks. So I'm making 47 ticks on the trade if it gets to that level and I buy out. And then if I do 10 of them, because we have 10 on right now, right? I have 10 contracts, so $470. So that's my profit potential if it goes back down to 26.30. All right? And I can go in and I can go, okay, so what was my risk on the trade? Well, I sold at let's see, the ceiling actually is first you're going to look at. So the ceiling is 2.700. All right, so that's that number on the right side, the higher number, the ceiling of the box. All right, minus where I sold it. And I sold it at 2.677, so that caps my risk. 2.677. 23 ticks. So divided by 0.001, because it's in 3 decimal places. All right, 23 ticks. I did 10 contracts, $230, $470 potential profit. All right, so right there, I can see that I have a 2-to-1 reward-risk ratio if it just gets down to 1.2630. And so that's just a really, really good benefit when you're trying to find a trade and you're trying to figure out what is my profit potential on this trade versus what is my reward potential on the trade, and not just your maximum reward. Like I said, because if I go and I look at maximum reward, I mean, it can be through the roof there, $1,700, and that's great. But do I expect it to fall all the way down to $2,500? Probably not. So where do I expect it to move to? And that lets me know, okay, this is where I should be looking at my risk-reward ratio. Not simply, the maximum potential, but what is my expected potential profit. All right? And so that gives us a nice risk-reward ratio on that trade, and even allows us, if we want to take off half. So let's say we think it's going to keep going. All right? So now what I can do, let's say if I want to take off half, why would I want to take off at least half at 1.2630? Well, since my risk-reward right here, we know at 2.630 is 2-to-1 risk reward. If I took off half, I would remove my risk from basically by taking a profit. Then I remove the ability to lose money on the total position. Okay, I still have $230 of profit at risk, but I no longer have original invested capital at risk. So because I would make $235 at 1.230. So now I can go in here, and let's say I want to take profit in, so I don't have to be sitting around and babysitting it. So I go in and just change that number to 5. So 5 versus 10 contracts. So I'm going to take off half, and then change my take profit price at 1.2630. Now I hit place order, and when I do that, then what it's done automatically is I can see it in my working orders down here somewhere. It's hiding there, and then under my here we go, working orders. Then I can actually see that order working for me. So whether or not I'm there, it'll take the profits off. So I can sit it, basically forget it, walk away. If it comes down, fills that, and goes back up, then you know what? I'm still going to be up a few bucks. Not counting for any kind of fees or whatever, but just the flat out profit and loss on the product. But if it keeps going down on the other half, then I can let my profits run. All right. So I've limited my risk, and I've let my profits run. So if we do have a move, let's say it does move all the way down to to 2.5, then I do have a massive $700 additional profit that I can make because I still have 5 contracts on. So layering in different abilities to remove risk from original investment, to take some profits, and then to maximize profits. And you may even want to go, well, I don't know if it's going to go that far, but maybe I think it'll go down to 1.26. I don't think it'll go to 1.25, but just in case I'd like to maximize that, I may go in and say, I'll take off 3 contracts at 1.260. All right. So now I'm locking in some additional profits on 3 of my contracts, but I have 2 more that can go for that additional $200 in profit. Okay, so layering in your profit taking is just definitely a great strategy on anything that you trade. Doing either 2 or 3 divisible number by 2 or 3. So whether it be 1, 2, and 3, basically 3 contracts, whether it be 6 contracts or 12 contracts or 20 or however you're doing, using that to your advantage. Now, another thing I was looking at earlier was I was checking out corn, and I want to show you an example on this right here, because this is a good lesson to learn if you're looking at trading these spreads, is sometimes you can't find one with a floor or ceiling close to where you want to trade. And let's make sure we're looking at the right contract, so we need to make sure we're looking at the September contract. So if I go over here, how do I know that? Well, if I go to corn, and click on, we'll just put the daily 200s there up, and it says September. So you need to change it over to the symbol for September there is U. And I'm trying to find, like I said, just a good trade that'll work out real well for me, but I have a problem. Corn is at 810 right now, and I want to short corn. Okay? So if I want to short corn right now and it's at 810, then, well, actually, if I want to short corn, it's great. Sorry, if I want to go long corn. So corn's running if they keep going up. Sorry to be confusing there. But if I want to go long corn, then I could buy this spread. If I bought one of those, $100 risk, $100 reward. That's 1-to-1. That's okay. It's not ideal. All right, what if I want to buy this one? Wow, $12 profit, $188 risk. Not really the one I want to do. Okay? And I go over here and I could look at, buying this one. Well, I can't even buy it because nobody's willing to buy it because basically there's no profit to be made. So basically not a trade that I'm really looking at either. So what do I do? Well, what I can do is I can combine these two spreads together. Okay? And I can make a synthetic box. I can make my own box when no box is to be found. All right? So I can go in and I can buy the 800 to 810. And here's what that would look like right here. So the 800 to 810 spread, or the 800 to 820 spread. And what I'll do is I'll add that box on the screen so you can see. Yeah, we got that already selected. Good. So 820 down to basically 810 right there. Close enough. And then I can sell. All right, so I'm buying this one. I can sell the 790 to 810. So let's see what that looks like. So now I'm going to put that one on here. 790 all the way down here. Okay? And it's actually 820 to 800. Yeah. So it's even a little bit bigger. So we'll drag that all the way down. There. So basically I have two boxes on top of each other. And what that means is I've made my own synthetic box. Remember what we said is there was no box to buy where we could find a good profit potential? Okay? So by selling this 790 to 810, I have a risk on that of $12 for one and a profit potential of 188. Well, by buying the 800 to 820, I have a risk of 100. I can make 100. Okay? Well, by combining them together, then that's actually not my risk. What is my actual risk if I put these two together? It's basically what I refer to sometimes a hedge trade. Okay? But also the hedge trade can be used to make a synthetic box. So if I want to go in and I bought this one, 810.2. Okay, that's the buy price right now, the quote. Or now it's changing, of course, on us. But so 810, and I sold the 808 one. Okay, then I got 2 or 2.0 because it quotes in 0.1 decimal place. So divide that by 0.1, 20 ticks. So I have a $20 risk on the trade, okay, on this trade right here, and I will not lose any money. More than $20 is my maximum risk no matter where it goes. So when we come back, I'm going to wrap up how the synthetic box works and exactly what you can do to make your own box at your own strike whenever you can't find one that works for you.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to check out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday, Wednesday, and Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
Catch Tom O'Brien and Steve Rhodes as they teach you the art of mastering money when it comes to trading and investing. The Money Masters, next on TFNN.
All right, folks, welcome back to Diagnostic Trading Hour here. All right, so we were looking at this potential box trade setup, and the problem that we had is we wanted to buy oil. It was right when it was at 810. It moved up about a point now, and we couldn't find a spread that had a floor of 810. And so what we did is we made a synthetic box. And the synthetic box actually has several cool points to it. One is now we have lowered our risk because we won't lose money there in that sense of below the 810 mark. And what happens is this 810 and this 800, 820, they basically straddle each other in this instance. And so this one stops losing money, and this one starts making money. And so we can look at, we can pull that up right there, and we'll update the prices, and we can look at what it actually comes out to. But it was a little bit better there before when we were at a 1-to-1 earlier before the break. But right now, if we went in and we bought at 811.4 and we sold at 808.7, basically we have a $27 risk on the trade. Okay, so $27 risk versus if I buy this one right here because I wanted to buy a spread on oil, I'd be risking $114. So $27 or $114. Which one do you prefer? Okay, same trade as far as, because I mean you can make money up to 820, all right, but less risk. So now, and here's the other really cool part. Okay, now the hedge that we have on, it obviously hedges us all the way down to 800, but it even hedges us further. It hedges us down to 790. So let's just say that corn just started dropping, and it can definitely move 20 points in a day. I mean, it's up 20 points today. So it can definitely move down 20 points from where it's at right now. If it moved down to 790, actually if it goes below 800, then the short straddle will actually start making money in addition to what the long, the short spread will actually start making money in addition to what the long spread made. So this one's risking $114. It'd make $114, and it would keep making profits. So you could actually make money if it moved down a whole lot, or if it moved up a little bit. All right. So it doesn't have to move up that much at all. But if it moves up just a little bit, then you actually can make some money. It only has to move like half a point. And on that third point, you're actually on the, I guess, 3/4 of a point, you're profitable. And everything above that, you can make money all the way up to 820. But again, if it moves down below 800, then the short spread starts outpacing the long spread, and you can make money on the downside as well. So this is not only a straddle, not only a hedge trade, but it's also a synthetic box. It's three things in one, and has a lot of benefits for you. And all the while, if you weren't looking at combining two spreads together, all you would have saw is there's no good trade available for me to trade because I can't find a box with a spread that has a floor close to where the market's at, so my risk is too high. Whereas with this, we're like, wow, we made our own, basically, floor. We gave ourselves the potential to have limited risk on the downside, profit potential on the upside, and even have profit potential on a big move back down. And so I hope you picked that up. That's a sort of a cool way to combine them together. We keep sort of building on top of this and putting it all up there. But anyways, if you have any questions, always feel free to call in and let me know. And I want to go ahead and do a market wrap for you real quick before we wrap up this show. And with the show right here, we got the S&P is still just up 3.5. And basically sort of a flat market that we've been looking over the last couple of weeks. There's been some moves as far as if you get in the intraday, which we are obviously long-term traders seeing nothing. But short-term traders, we're hopping in, hopping out, and enjoying it. And sometimes it's a little easier to trade some of these smaller moving markets. And even with the smaller moving markets, you can always make money looking for, or not always make money, but you can always look for other opportunities to make money in different markets. That's why I like Nadex, because I can look international indices, forex, commodities. So there's always something to hop over and look at versus just being, in just one segment. But the S&P is up 3.75, the Russell up 5, the Dow up 34, and natural gas is up just a little bit right now, and may keep moving. We'll see. And we got oil down $1.06, and basically all the markets just moving a little bit here and there. So keep track of it, and make sure you watch out for those unemployment claims reports and Italian bonds tomorrow. All right, y'all have a great day, and I will see you tomorrow, 12 o'clock Central, 1 o'clock Eastern.